Have you ever noticed that the best opportunities in gold rarely appear when everyone is excited? They usually show up when confidence disappears, headlines turn negative, and investors start giving up. Right now, we're witnessing one of those moments. Gold and gold mining stocks have gone through weeks of pressure, sentiment has collapsed, and many investors are asking the same question. Is the bull market over, or is this setting up one of the biggest buying opportunities we've seen in decades? That question is exactly what we're going to explore today. Because while the recent price action has frustrated many investors, the bigger picture may be telling a very different story. Over the past several weeks, gold has struggled despite strong long-term fundamentals. A stronger US dollar, rising energy prices, and renewed concerns about inflation have all combined to put pressure on precious metals. Whenever investors rush into the dollar as a safe haven and markets begin pricing in the possibility of higher interest rates, gold often faces short-term resistance. But here's what makes this situation so interesting. Markets don't stay focused on short-term headlines forever. Eventually, investors begin looking ahead. And when they do, they start asking whether today's fears will still matter 6 months from now. If geopolitical tensions begin to ease and the global economy settles down, one of the biggest drivers supporting the US dollar could gradually weaken. That doesn't necessarily mean the dollar has to collapse. Even a slow decline could become an important tailwind for gold. At the same time, inflation remains a challenge that central banks haven't fully solved. Energy prices may move up and down, but inflation isn't driven by one factor alone. Governments continue carrying massive debt, borrowing costs remain elevated, and policymakers are walking a very fine line between controlling inflation and protecting economic growth. This creates a difficult environment for the Federal Reserve. On one hand, officials want inflation closer to their long-term target. On the other hand, pushing interest rates too high creates risks throughout the economy. Millions of households are already feeling the pressure of higher borrowing costs, while businesses and credit markets remain sensitive to additional tightening. That balancing act could limit just how aggressive monetary policy becomes from here. And historically, periods where the market begins questioning future rate hikes have often created a much friendlier environment for gold. What's even more surprising is how gold has behaved recently. Yes, prices have pulled back, but when compared with the strength of the dollar and the rise in oil prices, gold hasn't fallen nearly as much as many analysts would have expected. That kind of resilience matters. Sometimes markets stop reacting to today's headlines because they're already looking toward tomorrow. Instead of focusing only on current economic data, investors begin positioning for what they believe comes next. If that's happening now, this recent weakness may actually be hiding growing strength beneath the surface. Another important signal comes from central banks. While many retail investors have become cautious, central banks around the world continue adding gold to their reserves. Month after month, official buying has remained remarkably strong. These institutions aren't chasing daily price swings, they're making long-term strategic decisions based on currency stability, global reserves, and financial risk. Yet despite that steady demand, many individual investors continue pulling money out of gold-related investments. Exchange-traded funds have seen persistent outflows, especially in North America, showing that confidence among everyday investors remains extremely weak, and that's where things become fascinating. History has repeatedly shown that some of the strongest rallies often begin when public sentiment reaches its lowest point. The majority usually loses confidence near major turning points, while experienced long-term investors quietly begin building positions before optimism returns. So the biggest question isn't whether gold has experienced a difficult few weeks. The real question is whether today's fear is creating tomorrow's opportunity, because if history repeats itself, the market may be setting up for something very few people are prepared to see. One of the biggest mistakes investors make is assuming that price alone tells the entire story. In reality, the most important clues often come from what people are feeling rather than what the chart is showing. Right now, fear has spread across the precious metals market, and that may be far more important than the recent decline itself. When optimism dominates the headlines, everyone wants to own gold. Analysts raise their targets, social media is filled with predictions of endless gains, and investors feel like they can't lose. But markets rarely reward the crowd forever. Eventually, expectations become too high, buyers run out, and corrections begin. The opposite is happening today. Many investors who were excited only months ago have become discouraged. Some are convinced that gold has already peaked. Others believe there are better opportunities elsewhere. Every small rally is being sold, and every pullback is treated as proof that the bull market is over. But history tells a very different story. If you look back over the past 50 years, major bull markets in gold have never moved in a straight line. They have always included painful corrections that tested the patience of even the most experienced investors. Those corrections felt frightening in the moment, but looking back, they were simply pauses inside a much larger upward trend. During the famous bull market of the 1970s, gold suffered a decline of nearly 50% before eventually reaching entirely new highs. Imagine living through that correction. Investors believed the story was finished. Many sold near the lows because they simply couldn't tolerate the uncertainty anymore. Then the market turned. Those who stayed patient were rewarded with one of the strongest advances in precious metals history. The same pattern appeared again decades later. During the mid-2000s, gold experienced another significant correction even though the long-term bull market remained fully intact. Mining companies lost a huge portion of their value, sentiment collapsed, and investors questioned whether they had made a mistake owning the sector. Yet once confidence returned, prices recovered far faster than most people expected. Even during the financial crisis of 2008, one of the worst market environments in modern history, gold mining stocks experienced an extremely sharp decline. Panic swept through nearly every asset class. Investors sold whatever they could, not necessarily what they wanted to sell. But something remarkable happened after the bottom formed. Within only a few months, many mining shares produced extraordinary gains as buyers rushed back into the sector. The recovery happened so quickly that many investors who had sold during the panic never managed to get back in at favorable prices. That's one of the biggest lessons every investor should understand. Markets don't send invitations before they recover. By the time the news finally becomes positive again, much of the opportunity has already disappeared. That's why experienced investors spend so much time studying sentiment instead of simply following headlines. When almost everyone becomes bullish, future gains often become limited because most buyers are already invested. But when nearly everyone becomes bearish, something completely different happens. There are very few sellers left. And that's exactly why extremely negative sentiment often becomes a powerful contrarian indicator. Recent market surveys have shown just how discouraged precious metals investors have become. Optimism has dropped to levels rarely seen in decades. Many traders have simply walked away from the sector altogether. Ironically, this is often when long-term investors begin paying closer attention. While retail participation has weakened, another group has continued behaving very differently. Central banks around the world have not abandoned gold. In fact, many continue steadily increasing their reserves despite all the short-term volatility. These institutions aren't reacting to weekly price swings. Their decisions are based on long-term financial security, reserve diversification, and growing uncertainty surrounding the global monetary system. That creates an interesting contrast. Large institutions continue accumulating while many individual investors are losing confidence. At the same time, gold mining companies are trading at valuation levels that many analysts consider historically inexpensive compared to their own long-term averages. After the sharp declines seen across the sector, numerous producers are valued far below where they traded during periods of much stronger investor enthusiasm. For value-focused investors, this combination attracts attention. Prices are lower, valuations are cheaper, investor sentiment is extremely pessimistic. Yet the long-term fundamental drivers supporting gold, including central bank demand, persistent inflation concerns, rising global debt, and economic uncertainty, have not disappeared. That doesn't guarantee prices will move higher tomorrow or even next month. Markets can always remain volatile longer than anyone expects. But history repeatedly shows that some of the most attractive long-term opportunities emerge precisely when confidence reaches its lowest point. The hardest part is psychological. Buying when everyone else is excited feels comfortable. Buying when everyone else is afraid feels almost impossible. And yet, throughout market history, those uncomfortable moments have often separated emotional decisions from disciplined investing. The biggest challenge isn't predicting every short-term move. It's having the patience to recognize when fear has become far greater than the actual long-term risk. And that may be exactly where today's gold market is beginning to stand. As we reach the end of this discussion, everything comes down to one question that every investor eventually has to answer for themselves. Are you going to let short-term emotions control long-term decisions, or are you willing to step back and look at the bigger picture? That's never easy, especially in a market like gold. Gold doesn't reward impatience. It has a long history of frustrating investors right before making some of its strongest moves. Prices can remain under pressure for weeks or even months, creating the impression that nothing is happening. Then, almost without warning, momentum shifts. Buyers return, sentiment changes, and the market begins moving much faster than most people expected. That's why timing becomes so difficult. Many investors spend their time trying to buy the exact bottom. They wait for one more decline, one more piece of bad news, one more perfect entry point. But markets rarely offer perfect opportunities. More often than not, by the time investors finally feel comfortable buying again, prices have already recovered significantly. This is one reason experienced long-term investors focus less on finding the exact bottom and more on identifying periods when value becomes unusually attractive. Today, many of the conditions that have historically accompanied major buying opportunities are beginning to appear at the same time. Investor confidence remains extremely weak. Gold mining shares are trading well below previous highs. Valuations across much of the sector remain historically inexpensive compared to long-term averages. Meanwhile, many of the fundamental reasons people own gold in the first place haven't disappeared. Global debt continues to grow. Central banks continue adding gold to their reserves. Inflation pressures remain part of the economic conversation. Geopolitical uncertainty continues creating long-term risks across financial markets. None of these factors guarantee higher prices tomorrow. They don't eliminate volatility, and they certainly don't mean the market can't experience additional pullbacks before finding its next major trend. That's an important point because every bull market experiences corrections. They aren't signs that the long-term story has failed. More often, they're periods where weaker hands leave the market while stronger, more patient investors quietly build positions. If history is any guide, those transitions often happen when very few people are paying attention. Another lesson investors often overlook is understanding their own risk tolerance. Many people say they're long-term investors when prices are rising. It's easy to believe you're comfortable with volatility during a bull market. The real test comes when your portfolio falls 20, 30, or even 40%. That's when emotions begin taking over. Fear encourages investors to sell at exactly the wrong time, while greed convinces them to buy only after prices have already surged. Breaking that emotional cycle is one of the biggest advantages any investor can develop. Before investing in gold or mining stocks, it's important to ask yourself an honest question. Can you truly remain patient during periods of uncertainty? Can you stay committed to your strategy even when headlines become overwhelmingly negative? If the answer is yes, temporary declines become much easier to manage because they are viewed as part of the investment journey rather than a reason to abandon it. Another important principle is position sizing. No investment should become so large that a normal correction creates financial stress or forces emotional decisions. Markets will always fluctuate, but managing risk properly allows investors to stay focused on the long-term opportunity instead of reacting to every short-term move. That's exactly why many professionals gradually build positions over time instead of investing everything at once. A disciplined approach like dollar-cost averaging allows investors to reduce the impact of short-term volatility while steadily increasing exposure during periods when prices remain attractive. It also removes much of the pressure associated with trying to predict every market swing. Whether gold moves slightly lower next week or begins recovering tomorrow, the long-term strategy remains consistent. The biggest opportunities often belong to investors who understand that markets are driven by cycles, not straight lines. Optimism eventually replaces pessimism. Fear eventually gives way to confidence. And periods that once felt uncomfortable often become the moments people wish they had taken advantage of. So, is this truly one of the most hated setups for gold in the last 50 years? The evidence certainly suggests that investor sentiment is extremely negative. Valuations across many mining companies remain historically attractive, and long-term macroeconomic challenges continue supporting the case for precious metals. Whether this marks the exact bottom, nobody can know with certainty. But history reminds us that markets rarely reward the majority at emotional extremes. The greatest opportunities often appear when almost nobody wants to believe they're there. That's exactly why successful investors don't simply follow headlines, they study history, focus on fundamentals, manage risk carefully, and remain patient while everyone else is focused on today's fear instead of tomorrow's potential. Thank you for watching AG John OG. If you enjoyed this analysis and want more in-depth coverage of gold, silver, inflation, central bank activity, and the biggest trends shaping global markets, make sure to subscribe, leave a like, and share your thoughts in the comments. I'd love to hear whether you think gold is building its next major rally or if more volatility still lies ahead. Thanks again for watching, and I'll see you in the next video.